Hey, welcome back. Getting back with even more oil and gas companies with 3 interesting and very requested options. Make sure to watch the previous 2 as well because there are some very good companies in there. And don't forget to leave a like and a comment if you want to see more. Now, ConocoPhillips, this is one of the top US oil and gas producers with projects in several countries. After a massive jump in capex, they can make a decent 10-15 billion on average, especially after a recent acquisition that I'll mention in a bit. That's not a terrible amount for a 100 and something billion market cap, especially after it fell a bit, but not very far from their 10-year median. So a lower ratio than Exxon, but significantly higher, even double or triple compared to European or Latin American companies. We see some cost cutting already, but the report we have is before April and the effect of tariffs and OPEC ramping up production. I think with oil companies in general now, it's better to wait for a Q2 report and see what they say. They offer some very nice cash flow sensitivities to get an idea about their potential, but something to note here is that this estimation applies above 60 per barrel. It's good that they even mention 60 because we can get an idea of when the issues could begin. Reducing production, firing people, investing less, it's normal for oil and other commodities. Financially, we see a good position with the current assets covering the current liabilities and not a lot of debt. I think it's actually very similar to other oil companies that we've looked into. But the equity is actually very far from the market cap, so relatively speaking, you have to pay quite a lot for what you get. And think about it this way, we've looked into Oxy, Total, Shell, what is it that they have that justifies paying even more than 50% for their net assets? You want natural gas? You have Total. You want high dividends and buybacks? You have again Total and Shell. You want high quality US exposure? You have Oxy. What is it that ConocoPhillips offers that's not already cheaper in the market? I'm sure there are things, but again, paying even twice the equity for it. They recently bought Marathon using the stock for about 22.5 billion, which they even expect to generate about $1 billion in synergies from year 1. I looked into the acquisition before and it's quite good overall and a nice company to pick. Again, this is the advantage of a smart company that's utilizing an above average valuation to develop. Being valued at 20x the average cash flow, let's say, and buying a company at 10x what they can make instantly adds massive cash flows per share. On top of that, you get this type of synergies which are a bonus that can solidify a very good position. Especially now with BP selling assets, maybe they can get even more. They pay a decent 3.5-4% dividend representing about 4 billion plus another 5-6% in buybacks for now. But that's not very sustainable, so I think we can expect a cut soon if oil prices don't improve, even if they cut the capex. Back in 2016 we've actually seen about a 66% dividend cut, so don't expect a stable dividend from this. But again, I don't see anything special. This is among the worst deals you can find in the market right now. Even Exxon pays a bit better and you get much more stability since they are a dividend aristocrat. But sure, if they fall enough, any oil company has potential to pay massive dividends. So I don't really like the price that much. Sure, it's a good company and I like the focus on natural gas in the US, but comparing them to Equinor, it's basically the same size for almost twice the price. I think it's very similar to Exxon, being a market favorite that comes at a premium. They can keep doing acquisitions thanks to it, but I think there is even potential to see a giant like Exxon eventually buy them because it's among the most they can add in one transaction and they have good assets overall. But again, for now it's definitely not a buy for me due to other options being just better from almost any point of view. Now Equinor, this is the #1 Norwegian oil company with a majority of the revenue coming from there, but they also have some projects in Brazil, the US, UK and more, and also have some wind and solar farms. Norway actually owns about 74% of them plus another 8% through some pension funds. They have some typical issues with the new projects with activist groups delaying them, but the country overall is very much in favor of this type of project. Obviously, especially now with Russia out, Norway remains an even more important pillar for Europe's oil and gas, so this type of company becomes essential for the entire continent. Anyway, more about that in a bit. We see another company cutting its green ambitions to adapt to the political environment, which I think is a terrible thing to do when OPEC Plus has such an obvious influence and interest. I'll mention this at the end, but just think about who wins if the US US and Europe run out of cheap oil and don't invest in a replacement. Even with a higher capex, they can make a nice, let's say 10 billion on average, which is very good for a 65 billion market cap. That's among the lower ratios in the industry and kind of an average for Europe now, but there is something very important to keep in mind about Norway, which I'll mention in a bit. Financially, we see a good position, with the current assets above the current liabilities and overall not that much debt. The equity is pretty far from the market cap, which is actually not that common for Europe. Total, Shell, BP and others are even trading at a ratio of 1. This ratio is something we see from Exxon or Chevron, which are much higher than average. There is a premium for quality, sure, but I'm not sure it's that justified. Similar to Shell, I think this is the effect of the massive buybacks, which kind of prevent the stock from falling, and I can say that I like it. You know, instead of offering an opportunity to at least buy them at a net asset value, they overpay to not cause panic. But unlike Shell, can they say that there isn't something better to do with the money? Shell is buying at around the value of the equity, not 50% above it. How is it better than buying a competitor at 10% above it, let's say? You know, this isn't a tiny company that doesn't have money. They can easily buy even a medium-sized competitor anywhere on the planet. But the same I said for Shell, this may be part of a plan to keep the stock higher than buy another company using it. When competitors fall maybe even at 0.8x the equity, they could scoop up some very good assets even below their fair value using a more expensive stock, if that's the plan. If not, I don't see how that's not a mistake and a waste of money. But keep in mind that at least in Norway, they have to pay about 80% in taxes like any other oil and gas company. And since something like 95% of their revenue comes from Norway, we are looking at an effective tax rate of around 72% overall. So a lot of their potential is limited and it's not really possible for them to make a ton of money and really enjoy it. Not only that, but capex is immediately tax deductible in Norway, meaning that in good years when they make and also invest a lot of money, the cash flow will be inflated. In reality, taxes are just mounting up and become a long-term liability that they'll have to pay. They are only winning time now by investing. You know, it's like 14 billion that will eventually have to be paid. That's something they'll most likely have to pay when they cut the capex, meaning during the bad times. So up cycles are limited and down cycles are even worse due to backward taxes. They don't owe a ton of money, but just know that the cash flow can be a bit misleading. And also know that the net income takes them into account when they are recorded, not when they are paid, so use whatever you prefer. Neither is perfect, one is too low, the other is too high. By the way, if you want to support the channel and see when I buy anything or even get a custom stock analysis or even 2 each month, check out the Patreon link below. And now you also get all the other analyses ever requested by other members on top. We saw them pay a very nice 6-8% dividend plus almost 10% in buybacks, although that's not sustainable. Of course, when you have oil prices falling and especially in this case with the back taxes, you'll see them cut it. But usually it's something like a 4% yield on cost on average, which isn't terrible while waiting for an upcycle. It's about the risk and reward you prefer. Just know not to expect high dividends forever, especially if you buy during the upcycle, which is very risky. So overall we see a good and healthy company, but keep in mind the issues in Norway. It's a very low risk country that should be even more vital for Europe, especially after cutting Russia out, but your potential reward is limited by the country. I don't really like the current price and the focus on buybacks, but if they can fall maybe around the equity, it's not a bad company at all. You know, at that level they'd be among the cheapest based on what they can make on average, and the potential long-term dividends and buybacks can also be very impressive. We are talking about potentially some 10-15% returns plus the potential stock appreciation, so not bad at all for Norway. But if they fall that much, wouldn't companies like Petrobras, Devon, Oxy, Aker and others be even more attractive? We'll see. Now BP, this is a British oil and gas company that's among the biggest producers on the planet. They have a lot of up and downstream operations pretty much everywhere on the planet, plus, until recently, a very significant focus on green energy. They can make a good amount of money, like 10-15 billion on average, which isn't bad for a 70-80 billion market cap. We can see that it fell quite a bit, especially due to a jump in capex plus lower oil prices. Given the current environment, it's very likely likely to see it drop even more. I'd say it's okay, but not really that amazing when comparing them even to Shell, which we looked into in the previous video. They plan about 20 billion in divestments by 2027, recently announcing the sale of Castrol, the popular lubricants maker. So that will obviously have an effect on the cash flow, but probably the main attraction about them is the turnaround potential, but more about that in a bit. Financially, we see a good position, with the current assets covering the current liabilities and even a bit of the debt. The equity is pretty much similar to the market cap, so they are basically trading at a net asset value. But again, keep in mind that we are technically still in an upcycle and the assets can be inflated and all the inventories, investments and even property can drop in value quite a bit during the downside. Plus a bit of goodwill and intangibles, which are questionable to begin with. This is why I normally want a 25-30% discount to net asset value for a better margin of safety. You know, just the value of the inventories dropping like 20% since March means another 7-8% drop in equity. So they aren't at a price to book ratio of 1 anymore. They were at oil prices from March, not April, May or June. But there is also potential to be bought, and we have some rumors of Shell being a potential buyer. I wouldn't say it's that amazing of a buy now for Shell, but if BP continues to fall and Shell keeps up the buybacks, which inflates the price, it might soon get to a nice level for them to buy. Probably the main reason why the stock is underperforming is the focus on green energy and now shifting away from it. This was actually a pioneer and investing probably the most in the industry, which is impressive especially given the size. This also played a role in the company's pretty low margins recently because it's basically a long-term investment, not something that pays out immediately. At the same time, getting back to the profitable fossil fuels that we know they know how to do could lead to a potential comeback. This is why I think they have quite a nice turnaround potential and could even spin off the green branches if they want to, and if things don't work, they probably aren't that far from a potential buyer's price. But obviously this can get messy and risky, especially if oil prices continue to fall. Again, the real net asset value is already affected, and if everyone has issues and cuts the capex to go into self-preservation mode, who's going to buy? And they also pay a very nice dividend plus massive buybacks, being among the highest yields in the industry, although they cut the buybacks quite a lot now. That 6.5% dividend means about 5 billion per year, so it actually seems very sustainable, especially since they target 4-5 billion in structural cost reductions by 2027. And one thing about this focus from beyond petroleum back to British Petroleum, once again, this is an important example for all oil companies. If you focus too much on this but the demand simply isn't there, you take a very big risk. This has to be done together with a political environment which is very unpredictable and can change quite a lot, especially in Europe where you have a rise in far right which is against anything green by default. It's even more uncertain when those investments could pay off. You know, you have half a decade of focus on green, then half a decade against it. That's literally uninvestable territory. So oil companies actually have to navigate it quite well. And I'll briefly remind you what I said in part 1. Think about who wins in the long term if the US and Europe deplete their cheap reserves basically at the same time because they are pushed by politics. Then, without a focus on alternatives and cheap options running out, guess who's there to sell it? So BP is definitely interesting. You have a healthy and powerful company that's now kind of caught in the middle of politics and policies. But I think it has potential to be a turnaround play, so it would be kind of similar to Ecopetrol, who I think can easily jump like 60-100% in a year when the presidential elections are over. And as I mentioned with other companies, the balance sheet can offer a safety net. You know, they are at a price to book ratio of 1, but say it drops to 0.7. Why wouldn't Exxon or Shell, who are pumping a lot into keeping the stock price higher through buybacks, just buy them or only the company's best assets? Even with a premium, they probably make a profit and add some high quality assets using the stock. Do some cost savings, improvements, synergies, and that's value for you. And especially for a smaller company like Devon or Occidental, it's much easier for a giant to just buy them. So I think BP is currently worth paying attention to. So oil is in a very interesting spot right now. A potentially weakening dollar thanks to tariffs and rate cuts, but at the same time potentially higher production, lower investments but more demand. It's quite a rare environment. But there are some tensions in OPEC now, which has a major effect on the production, which could eventually lead to a cut that should boost the price again. Again, I see this as a response to the tariffs and basically showing the US that if OPEC wants, they can push them in a very tough spot. Even now at 60, that's already getting into capex cutting territory for a majority of US companies, which will have an effect on their production and future supply. Then, when prices go up and the US companies finally get to invest again, OPEC will already have the production capacity to enjoy the higher prices. And on the other hand, if we invest too much and deplete the cheap reserves now, that's not good either. Any way you put it, OPEC probably wins in the end when it comes to oil. The only alternative is investing in other options like green energy, nuclear and stuff, and basically cutting our dependency on oil. But politics get in the mix, and just keep in mind that there might be other interests behind all this anti-green stuff, and usually, at least in the EU, you can tie it back to Russia somehow. What a surprise, right? As always, what I cover in my videos shouldn't be enough for you to make any investment decisions, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.